January 1980, two Texas billionaires controlled so much silver that they owned roughly half the entire world's deliverable supply. By March, they'd lost it all in a single afternoon. This is the story of the Hunt brothers and how close they came to accidentally breaking the American financial system on their way down. Nelson Bunker Hunt and William Herbert Hunt were heirs to one of the largest oil fortunes in American history, and they had a theory. They believed the U.S. dollar was going to collapse under inflation. So starting in the mid-1970s, they began quietly buying physical silver as a hedge, the same way someone might stockpile gold, except they didn't stop at a reasonable amount. By 1979, silver sat around $6 an ounce. The Hunts kept buying, using enormous amounts of borrowed money and recruiting wealthy partners from Saudi Arabia to join the position. Their buying alone was moving global prices. By January 1980, silver hit an all-time peak of over $50 an ounce, up more than 700% in about a year. The Hunts on paper were sitting on billions in profit. Silverware collectors were melting down family heirlooms just to cash in. Jewelry stores ran out of inventory. It looked for a moment like the greatest trade in commodities history. Then the exchange running the silver market stepped in. Facing a market that had become dangerously unstable, COMEX changed its rules, drastically restricting how much silver any single trader could hold on margin, essentially designed to force the Hunts to start selling. This is the part almost nobody explains well. The Hunts weren't just holding silver. They'd bought most of it on credit, using futures contracts and borrowed money, betting the price would keep climbing to cover what they owed. The new rules meant they needed to come up with enormous amounts of actual cash, fast, just to keep their position from collapsing. They couldn't. On March 27, 1980, now known as Silver Thursday, the price of silver crashed nearly 50% in a single trading session, falling from over $21 to under $11 an ounce. The Hunts had received a margin call for $135 million they simply could not pay. Roughly $7 billion in paper wealth evaporated in one day, and their debts suddenly outweighed what their silver was even worth. Here's where it gets genuinely dangerous. The Hunts owed so much money to so many major banks and brokerages that their failure threatened to take those institutions down with them. This wasn't just two rich brothers losing a bet anymore. It was a potential chain reaction through the American banking system. To prevent that, a consortium of banks, led by Chase Manhattan, stepped in with a $1.1 billion emergency loan, essentially bailing the Hunts out to stop the damage from spreading further. It didn't save them, not really. The brothers spent the next several years fighting lawsuits, congressional hearings, and criminal investigations into whether they'd deliberately manipulated the market. In 1988, they were found liable for exactly that, hit with massive fines and eventually forced into bankruptcy. The family retained some of its oil wealth, so the Hunts didn't end up poor. But the empire that had briefly cornered nearly half the world's silver was gone. The regulatory rule that crashed their position, the one restricting margin on silver trades, still exists in modified form today, a direct response to exactly what the Hunts tried to pull off. It remains one of the clearest lessons in market history. You can be right about an asset and still lose everything, because markets don't just track value. They track how much leverage you're carrying when the rules change under you. If you want another story about someone trying to corner an entire market and the wild aftermath that followed, go watch our Diamond Cartel video next, and subscribe if you're into these deep dives.